Yeah, good morning, everyone. Welcome
Good morning, sir.
to the 21st of August 2022. And today we'll be discussing on consolidated statement of profit or loss and other comprehensive income vis-a-vis consolidated statement of changes in equity. We've more or less commenced group discussion starting from the general principles and up to the level of discussing with respect to consolidated statement of financial position. And we've learned a lot of principles there, which more or less are principles that will carry forward to every other aspect of the statements that constitute financial statements. If you go by way of the conceptual framework where the financial statement was defined and the component of financial statement identified, and we are more or less aware that the financial statement components are 5. Statement of financial position, statement of profit or loss and other comprehensive income, statement of changes in equity, and statement of cash flow, before we now get to the last section or component, which is the notes to the financial statements. Now, in this light, we are now moving to the second level, which is the statement of profit or loss and other comprehensive income, and to the third level, simultaneously, statement of changes in equity. In the next few sessions, we will be looking at this from the angle of a group, and likewise, we also look at consolidated statement of cash flow thereafter. Okay, which means by then we'll have more or less touched base on all of the aspects of the component of financial statement as it relates to group accounts. Okay, as you can see on the screen, we will be having extensive discussion by introducing the fundamental principles regarding how we proceed to consolidating the statement of profit or loss and other comprehensive income of the parent with that of the subsidiary. Similar principles will be adopted subject to 1 or 2 additional mechanics or principles that will be introduced with respect to carrying out successfully the consolidation in this regard. And in this regard, we'll be making use of consolidation schedule to simplify and aid all of what we'll be discussing in the course of this program. Okay, now I will want somebody to read. Let me try and enlarge this. I want somebody to read the excerpt of chapter 10, where we'll be getting our knowledge from, our fundamental principle from, and from there we'll move on. Who will volunteer to more or less lay the foundation? Mr. Adini was not here yesterday. We are here today. Therefore, we want you to lead us today. Thank you very much.
Good afternoon, Prof. Extension of basic consolidation. Yes, I can hear you, sir. Can you hear me? Can you hear me, sir?
Yes, I can hear you now, sir. 100%. Thank you.
Okay, sir. Extension of basic consolidation mechanics and principles in the preparation of statements of profit or loss and other comprehensive income and statements of changes in equity. This chapter will further provide the readers with the opportunity to understand and appreciate the mechanism, the mechanics and principles required to prepare the consolidated statement of profit or loss and other comprehensive income and the consolidated statement of changes in equity. The earlier mechanics and principles adopted in the course of preparing the consolidated statement of financial position are equally applicable to a large extent in this chapter. This chapter will consider in details the attribution of profit and total comprehensive income to the parent and the non-controlling interest in the proportion to which they are expected to share profit or loss, which may be subjected to some adjustments. In this chapter, guidance will be provided in ascertaining the amount of opening consolidated retained earnings or opening consolidated reserves and the amount of NCI as at the beginning of a reporting period.
Okay, thank you, sir. Now, we'll continue from this perspective, and I will more or less use this as an intro to explaining what we need to understand as an additional principle to what we've learned before. Okay? Over to you, sir. Okay, can you read this? I think you are muted.
It's better now, sir. Thank you.
Okay.
Extension of basic consolidation mechanics and principles in the preparation of statements of profit or loss and other comprehensive income and statements of changes in equity. As in the statement of profit or loss and other comprehensive income and statement of changes in equity of a single entity, which shows the result of the year operations, so does consolidated statement of profit or loss and other comprehensive income and consolidated statement of changes in equity show the result of trading in the year by the parent and its subsidiaries. Mechanics of consolidation. Consolidated statement of profit or loss and other comprehensive income and consolidated statement of changing in equity is a combination of the statement of profit or loss and comprehensive income and statement of changes in equity of the parent and its subsidiaries after making adjustments as it relates to intragroup transactions, that is, elimination of intercompany items, unrealized profits, and so on, and other related adjustments. The basic idea is to present one set of financial statements for all entities under common control. In the context of the statements of profit or loss and other comprehensive income, this implies presenting the result of all members of the group, i.e. the parent and all of its subsidiaries, in a single but considered consolidated statement of profit or loss and other comprehensive income. As far as the consolidated statement of changes in equity is concerned, this means just one statement dealing with all entities in the group. The entire financial performances within the statement of profit or loss and other comprehensive income are a simple aggregation of the results of the parent entity and all the subsidiaries. NCI is ignored in the aggregations as with the consolidated statement of financial position already considered within the context of this text. No controlling interest. In consolidating the result of a party-owned subsidiary, it is essential to note that the profit or losses of the subsidiary belong to both the parent and NCI, which have to be shared in the proportion of percentage holdings or investment in the subsidiary. IS1, preparation of financial statement, states that profit for the period must be analyzed between the profit attributable to NCI and profit attributable to equity holders, i.e. the ordinary shareholders of the parent. Reserves brought forward. It is essential to calculate or determine the amount of reserves, which included the retained profit of accumulated or accumulated losses brought forward at the beginning of the period from the previous year. For the purpose of consolidated financial statements, the consolidated retained earnings brought forward consist of 1, parent retained earnings brought forward plus parent share of post-acquisition retained earnings of the subsidiary.
Okay, thank you. Now let's look at the basic process. Now, before the basic process, let me go back to all of the narrative here. All of the narrative here is just saying that 1, similar to what we have done in the consolidated statement of financial position, we repeat similar principles here. One of which is that consolidation is done on a line-by-line basis. And what does that mean? Which means regardless of the stake the parent has in the subsidiary, whether it's 100%, is 80%, is 60%, or whatever it is, once control is established, you consolidate 100% of the result of the subsidiary, which means revenue of the subsidiary plus revenue of the parent, subject to any relevant adjustment, will be the revenue of the group. Similarly to cost of sales, similarly to distribution costs, similarly to admin expenses, similarly to income tax, similarly to any component within other comprehensive income. The second principle there is that though you control 100%, but you may not own 100%, therefore the results, which is the final performance of the subsidiary, cannot be only attributed to the parent. Why? Because the parent may not own the subsidiary 100%. Which then means that we then need to identify and try to attribute the group profit to those that belongs to the parent and those that belongs to the non-controlling interest. Okay? And thirdly, how do we determine the reserve of the group brought forward? Okay, I remember the reserve of the group is only reserved due to the shareholders of the parent, which means the reserve, consolidated reserve, is only of that of the parent, which then means that to ascertain that at any point in time is the reserve of the parent as a standalone plus the parent's share of post-acquisition reserve in the subsidiary. Okay, and why are we looking at post-acquisition? If you remember, the component of reserve of a subsidiary have to be split into 2, into pre-acquisition and into post-acquisition. Why? Because the pre-acquisition does not constitute part of the consolidated retained earnings. Why? Because that element constitutes part of the net asset acquired, which has been cancelled out in arriving at any amount of goodwill or gain on the bargain purchase, which that means that you can't eat your cake and still have your cake in your hands. In that situation, you have more or less used that in determining the amount of goodwill in comparison to the purchase consideration based on the net asset acquired, and therefore such amount cannot again be available with regard to distribution, or because it was what you paid for upon acquisition. And if you could remember, those are the principles we learn in principle 1, 2, and 3, which we call consolidation mechanic 1, 2, and 3. Now, to get all of what I've discussed down, these are the steps that are put together as steps that will guide you with respect to how you proceed to consolidating the line items of the parent and the subsidiary within the statements of profit or loss and other comprehensive income. And I want you to take it step by step And this will lead us to looking at practical scenarios to applying all of these steps. Over to you, sir.
Basic consolidation techniques. As earlier considered in the early chapter of this text, it is significant to primarily identify the group structure, as once again we will only consider the parent and subsidiary results, in this case, financial performance from the date of inclusion, which is the first date the parent obtains control of the subsidiary, i.e. the acquisition date. Again, we will be applying the single entity concept. Recall that consolidation entails parent results plus subsidiaries results plus or minus any adjustment. Step 1, identify the group structure, i.e. which company is the subsidiary. Step 2, eliminate any intra-group sales between the parent and subsidiary, not the associates or joint venture. This will be discussed later in one of the chapters. This will result in decrease, that is revenue, decrease in cost of sales. Step 3, eliminate any unrealized profit in closing inventory from intergroup sales. This will result in increase in cost of sales. Technical notes. Remember, closing inventory is reducing, hence causing the cost of sales to increase. Step 4, make any adjustment for current year additional depreciation due to any fair value adjustment or current year impairment. Increase in expenses, which could be cost of sales, administration, or distribution, follow examiner's instructions or use the most appropriate. Step 5, remove any intragroup interest relating to intragroup loans between the parent and subsidiary. This would lead to decrease in investment or interest income and decrease in finance costs. Step 6, remove any intragroup dividend. This will lead to decrease in investment income. Step 7, calculate the share of associates or joint ventures profit and add to the group profits.
Okay, thank you very much, sir. Now, this step, you don't need to memorize it. It's something that you get used to as well, more or less practical demonstration of our understanding on a one-by-one basis. Now, in doing this, let's start from the simplest position. The simplest position will take us back to what I call first principle with respect to consolidated statement of profit or loss and other comprehensive income. And in this manner, we want to look at a situation where a subsidiary is wholly owned. A subsidiary is wholly owned when the parent owns 100% of the equity shares, which means no other shareholders in the subsidiary other than the parent. Okay, what would be the position of that? Now, in looking at that, I want somebody to read this question, and from that perspective, we'll be able to provide a solution, and that will lead us to explaining those basic steps. Illustration 1.
Arsenal acquired 100% interest in the equity of Chelsea as January 1st, 2014, when it was incorporated. The board of Arsenal strictly wants to comply with the requirement of IFRS regarding consolidation of the financial statement. subsidiary out of parent as at 31st December 2016. Income statement for the year ended 31st December 2016. Revenue: Arsenal 600, Chelsea 390. Cost of sales: Arsenal 345,000, Chelsea 201,000. Gross profits: Arsenal 255,000, Chelsea 189,000. Distribution costs: Arsenal 75,000, Chelsea 45,000. Administrative expenses: 105,000, Arsenal 90,000, Chelsea. Income tax: profit before tax 75,000, Arsenal 54,000, Chelsea. Income tax 25,000 naira, Arsenal 29,000, Chelsea. Profit for the year 50,000 naira, Arsenal, Chelsea 25,000 naira. Movement in reserves: 10 profits brought forward 120,000, Arsenal 65,000, Chelsea. Profit for the year 50,000, Arsenal 25,000, Chelsea. Retained profit carried forward 170,000, Arsenal 90,000, Chelsea. Required: prepare the consolidated of profit or loss and the consolidated statement of change in equity, given that the share capital of Arsenal stood at 200 million and that of Chelsea amounted to 100 million. Please, can we move?
Thank you very much. That's the information. Now here, it is prepared the consolidated statement of profit or loss and the consolidated statement of changes in equity, given that the share capital of Arsenal stood at 200 million naira and that of Chelsea amounted to 100 million naira. Okay, that's the information available to us. Okay, what then do we do? Now, as usual, I'm going to switch to our templates. Now we have our template before us. Now, what do we do? The question, I've imported it the way you can see it. Now, and I have to create a template. Now, the first template I created is what I call consolidation schedule. If you remember, I said we are going to start our discussion and we'll be making use of consolidation schedule here to simplify our position. And what is a consolidation schedule? It's going to be like our working paper. So that the outcome of this working paper is what we are going to take to our formal statements of profit or loss. And what is this working paper all about? This working paper will show us that first, we try to replicate what is given to us as a question or information. Now, all of what is here, up to the point of profit for the year, is what we have replicated here. The only thing is that we have now made it in a columnar form where we have the parent, we have the subsidiary. I remember we talked about adjustments. We now create a column to aggregate all adjustments that affect each line item. And it is a sum of the result of the parent plus that of the subsidiary, plus or minus the adjustment, depending on the direction, is what will produce a group result. This group result is now what we needed. For example, this is what you present in your account, which means you just show your position as a group. Okay, if what's come to us, you show separate financial statement and you show group, which means if what's come to us, you show parents and the group. But you are not going to show your users of financial report, your subsidiary and group adjustment. Which that means that to do that, I've now more or less created a position whereby my group position, which I want to show, and I created a template for it so that this template is now my consolidated statement of financial statement of profit or loss and other comprehensive income, that the result I have here from this working paper will flow to this place. And that's why when you check here, this is cell S6. Cell S6 is taking me from the result of this consolidation, so that this is what you present to the users, but they are working that support what you present. Now, apart from these workings, remember also, IS1 requires you to attribute your profit for the year from a group perspective to that relating to the parent and that relating to the NCI. And that's why whenever you check any financial statement, model or real life financial statement, you'll see that after profits for the year, they will attribute the profit as follows and say, profit for the year attributable to owners of the parent and the non-controlling interest, all because this profit belongs to these two, provided there's non-controlling what? Interest. But in this question, we are told that Arsenal acquire 100% of Chelsea. What it then signifies is very simple, that parent is 100% and NCI is what? Is 0. But the beauty of this model is that I've created it to be dynamic, so that if I pick any other question that says Arsenal acquires 80%, I'll just put 80 here, and automatically my non-controlling interest will update to be 20. That means this is what you do in practice, so that you don't add code and make your model static and you start to input many values again. No, you make it dynamic so that once you change a variable, it influences every parameter to which that variable serves as an input. Okay, that is that in that regard. Now, what then do we do? In solving this problem, the first thing you do is that within your schedule, you must replicate all of these figures you have here. You bring them in. Okay, what then I'll do is to type them in one by one, which means I have revenue. I'll come here and say revenue is 600,000 for Arsenal. For Chelsea is 390,000. Now, I'll still leave adjustment. What I want to do is just copy all of this information the way they are and put it in my schedule. Now, since I have more or less copied my own, I'll just come and paste it to make it more faster for me instead of doing it one by one. Therefore, nothing has been done. You have not added any value other than you are replicating all what is here back here. Now, the question then is, what is my group position? My group position, if you remember, let me take you back. To our material. There, we do make mention that the consolidation entails the parent results plus the subsidiaries results plus or minus adjustment. Now, in this question, there's no information regarding adjustments, which then means that what I can simply do in this case is to go back and do what? I go back and say, adjustment here is 0. There's no adjustment in all of it, okay? Since we read the question, there's no information about adjustments. And adjustment is triggered by intercompany transaction. But in this question, there is no information that these two companies are trading with one another or doing anything with one another, nor having a financing agreement with one another. In that regard, therefore, adjustment will not be triggered. And in that case, since adjustment is 0, what then I did is to sum up all what I have here across board. Since adjustment is 0, it makes no impact. This is what I've done all through. And this is just a mere addition since there is no adjustment. Now, what then have I done is that all of these upon consolidation, I've linked it already here so that it is presentable in this manner, okay, to the users of financial report, which means the group revenue is 990. And if you check, it's flowing from here. Let me reduce it so that I can see it here. It's flowing from here. The group cost of sales is flowing from here. Group profit is the difference between these two. Distribution cost is flowing from here. Admin expenses is flowing from here. Now the sum of these two make up my operating expenses, which is 315,000. Now my profit before tax is the difference between my gross profit and my operating expense. My income tax is flowing from this addition, and my profit for the year is this minus this, which also is in tandem with what I have here, which shows that I'm okay. Now the next order is that the profit of 75,000 or 75 million, since all figures are in thousand, have to be attributed between the parent and the non-controlling interest. And how do we do that? It will be wrong for you to say, because NCI is 0 and parent is 100, you just apply 100% and 0. No, it doesn't work like that. And I'll explain why. Now, the way it works is this. This is the parent position. Parent is bringing 50 million to the table. Subsidiary is bringing 25 million to the table. Therefore, how do we address it? We'll come here and say, profit of the parent, this 50 million, is solely of the parent. NCI has no business in it. Whereas the profit of the subsidiary, which is 25 million, is what can be shared between the parents and NCI. But fortunately here, the parent is 100%, NCI is 0. But regardless of the fact, we'll still say parents 100% multiplied by this 25. Okay, and it means the entire 25 belongs to the parents. By the time we extend it to the NCI, you find out that nothing comes to the NCI. Why? Because the NCI has 0%. Now imagine the question is not about parents having only own subsidiary, but the parent only have 80% stake. What will be our NCI? 20%. By then, this 25 will be shared in ratio 80-20, which will now be 20,000 and 5,000. If it's 60%, it becomes 60-40. That is 15,000 and 10,000, which is this. You don't share that of the parent because NCI has nothing to do, nor business within the parent. The only common ground for them is the subsidiary. And therefore, let's go back to 100 and this. And it's from here that I now linked owners of the parent as the entire 75,000, which is flowing off from here. Why NCI as 0, which is flowing off from here. Why? Because we have no non-controlling what? Interest. Even when you have no non-controlling interest within a group, it is required that you show it, but it will be at 0. The essence is to make people aware that truly you have no non-controlling what? Interest. Okay, and that is the position there. Okay, that is that from the profit perspective. But we are not only interested in the profit perspective. As the question reads, it says we also need to show a consolidated statement of changes in equity. I remember statement in equity is trying to reconcile your equity or total equity last year with your total equity this year. Now look at it. This is how our equity looked like, statement of changes in equity. Let me enlarge it. This is how it's supposed to look like. Now, let me explain it. The consolidated statement of changes in equity for the year ended as 4 December 2016, you start with the opening balance, which is last year balance for the share capital, which usually is for the parent alone, with the retained earnings, which usually is the consolidated retained earnings. The sum of the two remember, will give us equity of the parents. Thereafter, we add non-controlling interest. Equity attributable to non-controlling interest is the sum of these two that constitute total equity. If you remember, let's go back to our balance sheet. Remember our balance sheet. This is what we are trying to mimic. That is ordinary share capital, parent, consolidated retained earnings, it gives us equity of the parent, plus equity of NCI will give us total equity. We are trying to reconcile these 280 from what it was last year, probably is 250 last year. How do we move from 250 to 280 based on individual components of equity, which starts from the share capital for the parent, the consolidated retained earnings for the parent, and the non-controlling what? Interest. And that's what we are trying to do in that manner. Now let's go back. How do we treat this? Now, I start with the share capital. Now, I need the balance sheet of the parents to determine the share capital of parent. But again, since they didn't give me balance sheet, but they've extracted the information, and I was told that the share capital of Arsenal was 200 million, which means I'll come here and say share capital of Arsenal is 200 million, or figure in thousands. Now, since there's no non-controlling interest, I have no problem. I just put this as a 0 because I'm aware that this is only own. But later on, we'll come to how we determine non-controlling interest as at the beginning. But I have challenge. My challenge is what is my consolidated retained earnings brought forward? Okay, now to determine brought forward, I'll come back to that with the explanation. But I'll rather start from things that are easy for me to do. And what are the things? Now, the profit for the year. What is the profit for the year? The profit for the year is this 75 million. This 75 million has been attributed to parent and NCI. And therefore, what I'll do is to come here and link that and say, parent take 75% out of 75, and NCI is taking 0 out of it. Which that means that if I've come back here to change this as ratio 80 to 20, you see the effect of that is that not only that it is taken as 75, in my statement of changes in equity, it's also going to recognize 75. Okay, in that regard, I've been able to attribute this 75 into the parent and NCI. Okay, but let me take it back to 100% as it is in the question. Now, how do we determine the retained earnings brought forward? To determine this retained earnings brought forward from the consolidation perspective for the parent, it is simply determined as follows. Recall, we read this before, and I'm going to repeat it again. Now, that is what? It is the parent retained earnings brought forward, which means parent retained earnings brought forward in this case is 120, which means at the beginning of the year. 170 is as at the end of the year because profit for the year has been added to the beginning balance. That's why it's 170 at the end of the year. But what is relevant is the beginning of the year, which is 120. Okay, another thing that is relevant is that parent means a share. The share of the parent is 100%. Okay, but what is the parent sharing? Is sharing the post-acquisition retained earnings. Post-acquisition means that they are not only picking the retained earnings of subsidiary brought forward, which is 65. They are not going to pick the end of the year because we are not calculating end of the year. We are calculating beginning of the year, which means what is relevant is 65, which is the beginning of the year. But within this 65, there's an element of pre-acquisition, which you have to deduct. Therefore, because pre-acquisition will have been used in determining goodwill, therefore it can't also be used again in determining consolidated retained earnings, which means you take it out, which means whatever is the pre-acquisition out of this 65 is removed from there. What is left is what we call the post-acquisition retained earnings brought forward for the subsidiary. That is when you can now apply your share, be it 100%, be it 80%, be it 70, 60, or whatever percentage it is to the parent. Now, on that basis, we will now produce an account. Now, how do we do that? In this case, I will ask myself, from the information here, we acquired Chelsea on 1st of January 2014. And we were told that this acquisition coincided to when Chelsea was incorporated, which simply means that as at the time Chelsea was incorporated is when we took control of that Chelsea. And as at that point in time, Chelsea would not have made any profit because it's just starting, which means at incorporation, the reserve of any entity is 0, which means there's no pre-acquisition reserve because as at that acquisition was the same period of incorporation, and therefore it means it is 0 pre-acquisition reserve. Now, but subsidiaries retained earnings brought forward in this information here is 65 million. Therefore, I come here, since all figures are in thousands, I put 65,000 here. Okay, which means if you add 1,000 to it, it becomes, let me put this 1,000 on top here, it becomes 65 million. Now, I also need information about parent entity retained earnings brought forward, which is this 120. I'll bring that one in, 120. Now, because I want to model it, I've done that. Now, look at this. We said reserve brought forward for the group, which is the consolidated retained earnings brought forward. It is the retained earnings of the parent brought forward, which is this 120. Therefore, this 120, I bring it down here, which is what I linked from here to say this is it, plus share or post-acquisition retained earnings brought forward for the subsidiary. The first thing is that before we talk about share, we need to know what is the subsidiary retained earnings brought forward, 65. Now, 2, we need to know what is the pre-acquisition retained earnings, is 0. The question then is 65 minus is 0 will give us 65, which means 65 minus 0 will give us 65. Now, which means this 65 here is post-acquisition. Now, since this is post-acquisition brought forward, what we then need is a percentage share. What is the share we are taking? Parent will take 100%, okay? Because we have it here, okay? And therefore you say 100%, this 100% of this 65 is how much? 65, okay? But let's see the reality. Imagine it's not 100% and 80%. You'll see how obvious it is. At 80%, it's no longer 65, it's 52, which means 80% of 65 here. Let's also see it. Imagine there's pre-acquisition. That means you are not acquiring at acquisition, okay, at incorporation, which means let's say you acquire about 2 years after incorporation and it has made profit of 10 million. Therefore, it means what is our post-acquisition will be 55, of which you take 80% of it, and that's 44. Or if it's 100%, you take 100% of 55, which is still 55. Which means what this expression means is that parent share of the post-acquisition retained earnings brought forward for the subsidiary. And that's why I've inputted this formula here for you to have an understanding of what we're talking about. Okay. Okay, that is it. Now, I'll go back. This is a 0. Now, to do that, I might decide to put it here. Okay, let me just put here post. Post-acquisition profit. Profit or was or loss. Okay. Let me paint it. So that's what I'll be using going forward. Okay. Let me have it as this. Therefore, this is what I've done. The formula is a parent percentage, which in this case is 100%, multiplied by, open brackets, the balance brought forward of subsidiary is 65, minus pre-acquisition profit, which is 0. What you get in this is this 65, which will now apply your percentage you have here. And that is it. Which means at the end of the day, the entire post-acquisition profits of the subsidiary is attributed to the parent, all because the parent owns subsidiary 100%. You consolidate it with that of the parent on a standalone basis to produce 185, which is what we have here. 185 is the consolidated retained earnings brought forward. Okay, now NCI is 0 because we've said earlier that NCI does not exist. Why? Because Arsenal owns Chelsea 100%. And from there, we are able to produce these results. And in this question, we have no information about other comprehensive income. In that, we have information about transaction with owners of equity. Remember, other comprehensive income can come by way of evaluation surplus or gain on evaluation, like fair value gain or losses, like cash flow hedge reserve, like actual gain or losses, and all sorts of things, which we don't have for now. Okay, and likewise, transaction with equity might be additional capital introduced, might be when you just acquire a subsidiary and you have to introduce the amount of non-controlling interest, or dividend was paid in a year. And all of these are things that will not pass through profit or loss or through other comprehensive income, but have impact directly on the component of equity. Those are the things you record or present within what we call transaction with owners of equity. Okay, in that case, there's nothing for now, and that is that. At the end of the day, we are able to reflect again our statement, consolidated statement of profit or loss, and also our consolidated statement of changes in what? Equity. And that is that in this regard. Any question? Any question? Any question? Recall, these are working paper. These are working paper where you consolidate line by line and you pick the figure here, you import it directly to your account where you'll be presenting to users of financial statements. Okay, and this is how we attributed these profits to both NCI and the parent. And this is how we determine the consolidated retained earnings brought forward. Similarly, we also show how we determine if we have NCI at the beginning. Therefore, how do we determine NCI amounts? We also show it later on. But in this case, we already know we have no NCI. That's why we don't bother stressing ourselves. All because Chelsea, as a subsidiary, is only owned by Arsenal, because Arsenal has 100% ownership of all of his ordinary shares and capital. Okay, if there's no question, now let's go back to our material to look at another scenario. And this time, we'll be looking at a scenario that's slightly different too. Now, as you can see here, because we don't have NCI, I might decide not to show NCI. But the best practice is always to show NCI, even if it's a new value. Okay, and that will be slightly in tandem with requirement of IS1. But for examination, you might decide not to waste your time, and this might look better in order to not to waste your time, since you know that everything attributable to equity of the parent is also total equity, since there's no non-controlling interest. Okay, but what you need to take note of at any point in time is that you need to be smart in what you do. Okay, but let's look at another scenario. Now, the second scenario, or second principle as the case is what if we have less than 100% ownership of the subsidiary. Therefore, we are introducing non-controlling interest. Therefore, what will happen in that situation? Now, I want somebody to read the question here, where we have a partly owned subsidiary.
After acquired 80% interest in the equity of Chelsea as of January 1st, 2014, when it was incorporated, the board of Arsenal strictly wants to comply with the requirement of IFRS regarding consolidation of the financial statement of subsidiary with that of the parent as at December 31st, 2016. Income statement for the year ended December 31st, 2016. We have Arsenal, we have Chelsea. So revenue for Arsenal is 600,000 naira, while for Chelsea is 390,000. Cost of sales, 345,000 for Arsenal, 501,000 for Chelsea. Gross profit, 255,000 for Arsenal. Gross profit for Chelsea is 189,000 naira. This can you help scroll up, sir? Okay, distribution cost, 75,000 for Arsenal, 45,000 for Chelsea. Admin expenses, 105,000 for Arsenal, 90,000 for Chelsea. Profits on, okay, let me say profit before tax is 75,000 for Arsenal and then 54,000 for Chelsea. Income tax, 25,000 for Arsenal, 29,000 for Chelsea. Profit for the year, 50,000 and 25,000 for Arsenal and Chelsea respectively. Movement in reserve, retained profits brought forward, 120,000, 65,000 for Arsenal and Chelsea respectively. Profit for the year, 50,000 and 25,000 for Arsenal and Chelsea respectively. Retained profits carried forward, 170,000 and 90,000 for Arsenal and Chelsea respectively. Required, prepare the consolidated profit or loss and consolidated statement of changes in equity, given that the share capital of Arsenal stood at 200 million naira and that of Chelsea amounted to 100 million naira, and the amount of non-controlling interest at acquisition as measured at fair value stood at 20 million. In this context of this text, we will approach.
Thank you. Okay, now let's solve the problem. Okay, in solving the problem, we've more or less created our templates. We brought the question in. Now, in this case, since we have non-controlling interest, and they didn't give us the balance sheet of the parent, neither did they give us the balance sheet of the subsidiary, and they didn't even give us enough information that will make us compute what is the non-controlling interest at acquisition. Rather, they've already computed it for us. First, they've made us know that they measured non-controlling interest at acquisition date fair value. And they've done the computation for us, and they said non-controlling interest at acquisition as measured at fair value stood at what? 20 million naira, which means we don't need to go ahead trying to determine what the market price is, what is the number of shares acquired, and all sorts of things like that. No, whether proportionate share, where we need to determine the net asset at acquisition and find our percentage of NCI, which means in this case, such was not necessary. And now, since it's not necessary, they've already done it for us. Therefore, I don't need to waste my time trying to compute it on my own. Therefore, in these slides, what do? Now we come back here. These are plain templates. Now, in this case, I've inputted 80% because of the information here, which means automatically my NCI is 20%. Now, in doing so, what then do I need to do? I need to go ahead and type all these figures exactly the way they are here, which means revenue here is 600,000 because it's my working paper. And Chelsea own is 390,000. Okay, Now, since there's no information about adjustments, I've already put everything here to be 0. That means adjustment is not required. Now, if I do this and you also do it at your own end, what do you get is exactly what I'm producing in front of you, which means I've not done anything other than to copy all what is here. There. And now, since there's no adjustment, it means it's just a mere addition of 600 to 390, which give me 990. 345 plus 201 give me 546. 75 plus 45 gave me 120. 105 plus 90 gave me 195. And that's just all, which means 50 plus 25 gave me 175, all because no adjustment yet. Now let me put this in red. There's no adjustment yet. Okay, let me go back to the first one. No adjustment yet. Okay, we'll be following this in a methodological way as a move on. Now, as I've done that, what then do I need to do? I need to attribute the 75 to parent and NCI. Okay, you can see it here. It's already linked. Therefore, this 75, what portion of this 75 is the parent? What portion is NCI? Don't be tempted to say, since parent is 80% and NCI is 20%. Don't be tempted to say, okay, that means it is 80% of 75. And 20% of 75. If you do this, you are wrong. Who can tell me why you are wrong? Even though you sum it up and it's 75, but it's not just mere addition, subtraction, division, or multiplication. Who can tell me why you are wrong if you just apply 80-20 on this total value? Who can tell me why you are wrong? Who can tell me why you are wrong? I can't hear anyone.
Sir.
Okay.
Yeah, because the total is for both the parent and the subsidiary.
The NCI has nothing to share from the parent portion.
Yeah.
Yeah, which means this is totally wrong and it's not acceptable. We take it out. Okay. Therefore, what do? We pick it one by one. Picking it one by one, we ask ourselves a simple question. This 75 is made up of 50 and 25. Now, this 50, which is parent, will NCI share in it? No. NCI doesn't have anything to do with the parent. Therefore, the entire 50 goes solely to the parents. At no point will you share to NCI because NCI doesn't have any business with the parent. NCI is an investor. I'm also an investor. Therefore, why are you coming into my own space to even eat out of what I'm doing in my own space? We can only jointly take something from the space we have more or less investment in, which is the subsidiary. In that space, you have 25. Okay, and in that case, we have to share it 80-20. Therefore, I'll take 80 of this 25, which is 20. You will take 20% of 25, which is 5. At the end of the day, what comes to me is 70. What goes to you is 5. And that is what we have here, 70 and 5. Okay. Now, that has come here because we have already linked it, which means I always tell you, you start from known to unknown, which means in solving problem, those that you don't need to do any extra work, just input them first before you start to labor on areas you need to do more things on in order to arrive at the solution. Now, don't forget, as at acquisition, you see at incorporation, it then means that our pre-acquisition profit is 0. Subsidiaries retained earnings brought forward as at the beginning of this year is 65. And the parent retained earnings brought forward at the beginning of this year is 120. And also, we need information about NCI at acquisition date, and we are told it was measured at fair value of 20 million. Therefore, I come here, I'll put 20 million. Remember, all figures are in millions. Therefore, what do I need to do? As usual, I need to determine my post-acquisition brought forward, which is the difference between my retained earnings brought forward and the pre-acquisition retained earnings of the subsidiary. And since the pre-acquisition is zero at acquisition, at incorporation, therefore, my post-acquisition is 65 minus 0, which is 65. Now, is this 65 that the parent will now take 80% share of? Therefore, I'll come here. The parent will take share of what? 80%. Where I'm getting the 80 from? 80% of this 65. Because 65 here is the difference between the retained earnings brought forward and the pre-acquisition reserve. Okay, and I take 80% of it. Now, since I have NCI, the remaining 20% of this 65 will go to NCI, which means I also come here and say NCI is 20% of this 65, and that is 13. When I add 52 and 13, it will give me 65. Okay, now let me now pick it. Parent on the standalone is retained earnings is what? Is 120 brought forward. Which means thereafter, 120 and 52 give me 172. And this 172 is the retained earnings of the parents upon consolidation brought forward. Now, NCI, I need the value of NCI as an acquisition. And this was the changes that has occurred since acquisition up to the beginning of this year. But I don't know what the value is at acquisition. It's either I go and independently determine it, or it has been determined for me. And in this question, it's already determined for us at 20 million, which we have already put here. Therefore, I can link it up to say my NCI as at acquisition is 20 million. When I combine all of this together, it gives me 33 million, which is my NCI brought forward at the beginning of the year. Now, don't forget, the share capital will be that of the parent alone. And they've brought the extract from the balance sheet of the parent to say the share capital of Arsenal stood at what? 200 million. Therefore, I come here and say share capital of Arsenal, 200 million. And this I will produce our results. And therefore, going forward, this is how we'll be determining our, let me put it in red. Okay, let me just leave it in black. Our consolidated retained earnings brought forward and our NCI brought forward. Okay, that is that. Any question on that? Now, therefore, this is what we show to the users of financial reports as our statement of profit or loss. And this is what we show as our consolidated statement of changes in equity. Any question on that? I recall again, this is our working paper. Everything we've done flows from consolidation schedule up to the point of profit attribution, up to the point of determining consolidated retained earnings brought forward for the parent and NCI brought forward. And that is that. Any other question? Okay, if there's none, let's go back to our material and look for another scenario we want to portray. Now let's look at this scenario. In this scenario, we want to reflect that though it's a partial subsidiary, partly owned subsidiary, but now the subsidiary was not acquired at incorporation. It was acquired on 1st of January 2014 when the retained earnings of the subsidiary stood at what? 20 million. And all other information remained the same or similar. Can somebody read that question?
Arsenal acquired 80% interest in the equity of Chelsea as at January 1st, 2014, when the retained earnings stood at 20 million naira. The board of Arsenal strictly wants to comply with the requirement of IFRS regarding consolidation of financial statements of the subsidiary with that of the parent as at December 31st, 2016. Income statement for the year ended December 31st, 2016 for Arsenal and Chelsea. Revenue for Arsenal and Chelsea are 600 million and 390 million respectively. Cost of sales 345 million and 201 million respectively for Arsenal and Chelsea. Gross profits are 255 million and 189 million for Arsenal and Chelsea respectively. Distribution cost 75 million naira and 45 million naira for Arsenal and Chelsea respectively. Administrative expenses for Arsenal is 105 million, while that of Chelsea is 90 million. Profit before tax is 75 million for Arsenal and 54 million for Chelsea. Income tax, 25 million for Arsenal, 29 million for Chelsea. Profit for the year is 50 million for Arsenal and 25 million for Chelsea, respectively. Movements in reserve. Retained earnings brought forward 120 million for Arsenal, 65 million for Chelsea. Profit for the year, 50 million for Arsenal, 25 million for Chelsea. Retained profits carried forward, 170 million for Arsenal, 90 million for Chelsea. Required, prepare the consolidated profit or loss and the consolidated statement of changes in equity, given that the share capital of Arsenal stood at 200 million naira and that of Chelsea amounted to 100 million naira, and the amount of non-controlling interest at acquisition as measured at fair value stood at 24 million naira.
Okay. Yeah, thank you very much. Now, the same question is what is presented before us, which means let me input relevant information. First, pre-acquisition retained earnings. Okay, before then, let me just copy the, what's it called? Let me copy the information the way it is here. Okay, now I have all of this information, which means I will type it. Having typed it, I copy it down here. Okay, now what then is the next information is that I need to populate all of these variables. Pre-acquisition reserve. Arsenal acquired Chelsea when the reserve of Chelsea was 20 million. Therefore, I'll come here. Pre-acquisition is 20 million. Remember, all of my information are in thousands. Now, retained earnings brought forward for the subsidiary was 65. Parent retained earnings brought forward was 120. And non-controlling interest is already measured at fair value, and in this case, we are told it's 24 million. Okay, those are the information. Therefore, we have no information with respect to intercompany transaction or whatever it is that will have warranted us to carry out group adjustment, which means in this case, group adjustment is still nil. Okay. Now, but what are we testing here? Is that we have consolidated this and we have reflected it here. Okay, the next thing is to attribute this profit. And how do you do it again? Is to find the post. Let me copy this. and put it by the side here. Now you can see that the post here is 45. Why? The difference between 65 and pre-acquisition 20 is 45. Now, but before then, let me come back here. This 75 is made up of 50 parent, 25 subsidiary. Therefore, parent will take his own 50, NCI has no business with it. But the one of subsidiary 25 will be shared between parent and NCI in proportion to the share profit or loss, which is 80% of this and 20% of it. And that's how we share it. There's no adjustment here, it's left blank. And therefore, this is how we share 70 and 5. Now, the next thing we wanted to do is to come to our statement of changes in equity. This is already populated as 75, which you have here, 75. Okay, now we have the share capital to be 200 million. Now, we need to determine consolidated retained earnings and NCI brought forward. Now, to determine that, let me start with consolidated retained earnings brought forward. I need the retained earnings of the parent first as brought forward, and that is what we have here as 120 from the information here. And I needed to take 80%, which is the share the parent has in the post-acquisition profits. And the post-acquisition profit brought forward is the difference between the retained earnings brought forward for the subsidiary and the pre-acquisition retained earnings. And that is 45. Therefore, this 45, I'll take 80% of it, give the parents, and I'll take 20% of it and give it to the subsidiary, which means 36 and 9 make up this 45. Now, what is my NCI at acquisition? Is either I independently determine it if I have those information, or it has been determined for us already at fair value of 24, which is what we have here. Therefore, I link it up with this, and then give me a consolidated position brought forward for NCI of 33, and for the parent, consolidated retained earnings of 156. And we have the 156 here and 33 here. And at the end of the day, I sum it across the row and I sum it across the column, and they must remain the same in that regard. Okay, and you can see that now we have introduced pre-acquisition. What impact does it have in this case? Is that it reduces, depending on the direction, the post-acquisition profit, where we now have to attribute that to the parent and the NCI before we prepare our consolidated statement of changes in equity. Any other question there? Now, check it once again. We started with line-by-line consolidation, subject to adjustments. And in this case, we have no adjustment yet because there have not been intercompany transactions. Now, 2, we attribute this 75 using this base of 50-25 in this manner. And we're able to be at 70 and 5, which flows on to our income statement here. Okay, and therefore to prepare statement of changes in equity, we need critical information. Apart from those things that flow from here and here, we need critical information with respect to retained earnings as consolidated brought forward and NCI brought forward, which is 156 and 33. How do you arrive at that? The parent retained earnings brought forward of 120, as you have it here, plus the parent share of this post-acquisition being the difference between the subsidiary's retained earnings brought forward and the subsidiary's pre-acquisition retained earnings. And that is 45. From this 45,000, we'll take 80% to the parents and we'll take 20% to the NCI. NCI also has its own value independently as measured at fair value at the acquisition date of 24. And that's what produced 33. And this produces 156. And in putting this here, we're able to produce our results in that manner. Any question? Okay, if there's no question, let's look at another illustration. Now we'll start to introduce little adjustments here. Now we want to see a situation where the subsidiary paid dividend. And when subsidiary paid dividend, in the books of the parent will have recognized dividend as an income. Whereas in the books of the subsidiary will have recognized dividend as a distribution within the statement of changes in equity, which is a reduction in its retained earnings, okay, or reserves. Therefore, how do we treat that? This will be the first adjustment that will be exposed to, okay? And in this light, I want somebody to read this, okay? But before then, I want you to read this, and later you support it with the illustration so that we can demonstrate our understanding on how do we pass group adjustment with respect to eliminating intercompany transaction that borders on dividend income from the subsidiary to the parent. Okay, who will volunteer?
Okay.
Consolidation subsequent to acquisition account and elimination of intercompany dividends, ordinary share computation to exist when a dividend is paid by the subsidiary during the term to which the amount of dividend received by the parent from the subsidiary is reported within the investment income parent profit. Investment income of the parent may include ordinary dividend received from subsidiary, income from other investments. Upon consolidation, only the income from other investments is shown separately as income consolidated profit. Why intercompany dividends are included in consolidation? The elimination of intercompany dividend income is necessary because the principle of single entry concept signifies that dividend considered as income earned and received or sometimes received from subsidiary is already a component of final results. Final performance with respect to subsidiary that have been consolidated into that of, and which invariably will be tantamount to double counting and duplication of for reporting. Technical note: don't retain any adjustment for dividend paid to the parent shareholders. Dividend paid by subsidiary to parent accounting of consolidation, and dividend paid to non-controlling interests are replaced by allocation of non-interest of the shares of profit or loss for the subsidiary. Illustration 4. Arsenal acquired 80% interest in the equity of Chelsea at January 1, 2014, when the return stood at 20. The board of Arsenal strictly wants to comply with the requirements of IFRS regarding subdivision of financial statement of subsidiary that of December 31, 2016. Income statement for the year ending December 31, 2016. Arsenal revenue: Arsenal 600,000, Chelsea 390,000, cost of sales: Arsenal 345,000, Chelsea 201,000, gross profit: Chelsea 255,000, Arsenal 255,000, Chelsea 189,000, distribution cost 5,000, Arsenal 45,000, Chelsea. Dividend income: Arsenal 107,000, Chelsea 90,000. Dividend income: Arsenal 2,000,000, Chelsea 0. Profit before tax: 75,000, Arsenal 54,000, Chelsea. Profit for the income tax: 25,000, Arsenal 29,000, Chelsea. Profit for the year: 50,000, Arsenal 25,000, Chelsea. Movement in reserves: Retained profit brought forward 120,000, 64,700 Arsenal, 67,500 Chelsea. Profit for the year 50,000 Arsenal, 25,000 Chelsea. Dividend paid Inter 10,000 naira Arsenal, 2,500 Chelsea. Retained profit carried forward 160,000 Arsenal and 90,000 naira Chelsea. That's all. I'm done. Required the consolidated of profit or loss and the consolidated statement of change in equity, given that the share capital of Arsenal stood at 200 million and of Chelsea amounted to 100 million, and the amount of non-controlling interest acquisition as acquisition as mentioned as fair value stood at 24. In this context of this test, we will approach a step-by-step approach of explaining the requirement of IFRS 10 with regards to consolidating the financial result of parent and subsidiary as the That's all. Arsenal, should I continue? Okay, Arsenal Group consolidated final statement of profit or loss for year end 31st December 2016. Revenue.
Don't worry, you don't need to read it. We'll solve the problem now. Thank you very much. Okay, now we'll follow the step-by-step methodology once again. And in doing that, the same principle we apply. And you'll see what we are going to do in this regard. Now, let me switch over to my template. Now, this is a question as being read, and the first thing I will also do is to more or less copy this and insert it where it's supposed to be, which means I populate this the way they have, my revenue and my cost of sales. I can type it. My distribution costs. Sorry. Okay. My expense, income tax expense. Okay, I've done nothing. Let me put this in red. Now the adjustment we need to carry out. And what is the adjustment? The adjustment is that there is intercompany interest, okay? And what entry will I pass to do that? Sorry, I said interest, dividend. Now, if you look at this question here, let me get my lighter. Now, in 10 dividend paid, now we are not bothered about that of the parent because it doesn't constitute an adjustment. We are bothered about the subsidiary. The subsidiary paid dividend of 2.5 million. This 2.5 million, if you have to analyze, let's analyze the dividend paid by the subsidiary. in the year. Now, when you pay 2.5, what percentage, what portion is due to the parents? And what portion is due to the non-controlling interest? Now, these portions are influenced by the percentage they carry. And what's the percentage they carry? 80 and what? 20. Now, when I sum up that percentage, it means all things being equal, I've shared it 100%. Now, what is the value? The dividend. All figures in thousands. That means that 80%, let me say the total is how much? The total is 2.5 million. Therefore, what percentage am I taking? I'm taking 80% of this is what is due to the parents. And what is due? What is due to NCI? It will be 20%, and that's 500. Now, what is intercompany? This 2,000 paid by the parent and paid by the subsidiary and received by the parent constitute what I'll call intercompany dividend. On one hand is an income. On the other hand is what? An expense. Therefore, what will I do is to eliminate it. How do I eliminate it? I'll explain. In this consolidation schedule, the 2 million is already shown here. Can you see it? The parent has recognized it as income. And that's why its profit for the year is 75. If he has not recognized it, the profit will have been 73, but he has recognized it. Now, but we are not saying that at group level, this is not an income. Why? Because you can't make income from yourself. The income must come from probably investment you have outside the group, not investment within yourself. What that means that what should I do? I should eliminate. Elimination means that income is a credit. I will debit it to this intercompany. And what happens? This plus this becomes a zero. Where would the corresponding credit go to? If you remember that I've taken this out, okay, which is 2 million. Sorry? Okay. Now, in this case, I've more or less reduced this 2 million. Now, the corresponding entry would be such that if I take away this 2 million, which I've done here, what is left out? What is left out is that gift to NCI, which is this. Is that of NCI, which then means that instead of being recognizing minus 2.5 here, okay, as you can see it from the subsidiary, since I've eliminated that of the parents from here, which means if I come here, I've removed from here, if I now remove minus 2,000, remember, I can break it down into 2,000 and 500. Parents, NCI. But I've canceled out that of the parents, which is what is here. Therefore, what is left for me after that elimination is 500. This 500 is what I recognize here as dividend paid out to NCI. And it's paid out of the profit that is still coming back to the NCI here. And I'll just remove this. I say, this is what is paid out of the profit. But again, we have not yet shared the profit, but this is how I eliminate the entire 2.5. 2 million away from the parents as a way of group adjustments, and 500,000 as a deduction from my non-controlling what? Interest, because whenever dividend is paid out of these profits, which by the time we share the profits and you pay out of it, it reduces what is retained in the investments of NCI. And that's what we try to do here with respect to whenever dividend is paid or declared by the subsidiary. Now, there are no other adjustments other than the one we have here, which then implies that what do we do? In that case, we have eliminated it. Now, for the first time, we are now having 50 plus 25 not equaling 73. Why? Because there's an adjustment of 2. Now, how do we treat this adjustment? That is what is new. But before then, let us deal with 50 and 25 independently. 50 goes to who? To the parents. 25 goes to who? Parent and NCI. Therefore, parent will take 80% of 25. NCI will take 20% of 25, and that is how we share it. Now, these 2 million adjustments we are making, does it affect NCI in any case? The answer is no. Why? Because it is the parent dividend income within the group that is being eliminated, which means all of this 2 million deduction is against the parent profit, because the parent profit is showing 50 instead of showing 48, which means, but because you have already shown 50, which you can alter, you now come to pass the adjustment, which means the adjustment you are passing is only going to affect the parent. Okay. And that is it, which means the 2 million, we are removing it from this 50 so that it's 48. Because if you have removed it here, which is not normal in accounting, you don't cancel in accounting, you use entries to remove. And therefore, using that entry to remove, without entry, if you say we just cancel the account, this is what will produce 68, because this is 48. But we leave it as it is, as 70, and now pass an adjustment to eliminate the dividend income within the group. Okay, and that's how we arrive at our 68, which means that 68 plus 70 plus 5 now will give that 73, which is what we have here. 73, all because here there's no dividend income, it has been eliminated. Now that elimination is against the parent only. That's why this is no longer 70, but 70 minus 2 to produce 68, which sum up to 73 we have here. You can see it here, and that is that. And this is how we pass such an adjustment. Now let's see what happens here. Can you see it here now? 68 is coming to the parent, and 5,000 is coming to the NCI, of which out of the 5,000, NCI has paid out, NCI has received 500 as dividend out of this one, because dividend is paid out of the profit. Now let's also go. Parent also have paid dividend to his own shareholder. This 10,000 is also deductible against the profits of the parent, which means parent has also paid 10,000, and that is a deduction. Okay, thereafter, what is the share capital? It's still remain the same at 200 million. Now we then need our consolidated retained earnings. How do we do that? We'll come back here and put all of these values. Pre-acquisition reserve, as at acquisition date, reserve was 20 million. Okay, we'll put it there, 20 million positive reserve. Subsidiaries retained earnings brought forward was 67,500. We'll put it there, 67,500. Retained earnings brought forward for the parent is 120 million. We put it there, 120,000 here. Non-controlling interest at acquisition was measured at 24 million. We come there, we'll put it at 24 million. Okay, remember what we have tried to do here is that every time we need to know the post-acquisition brought forward. Therefore, to determine the post-acquisition brought forward is the difference between the subsidiary retained earnings brought forward, 67,500, and the pre-acquisition reserve, which is 20,000, and that gives me 47,500. Now, it's from there, I can now take 80%. Let me show you how I got that again. 80% of this 47,500 will give me 38,000. And this 95, how do I do it? Is 20% of this 47,500 will give me 9,500. And that is that. Therefore, at the end of the day, I throw in 33,500 here, and I throw in 158,000 here. And at the end of the day, I'm able to produce 454 as my total equity. Does it make sense? Okay. Any question on that? Which means the first adjustments we ever introduce is adjustments that borders on eliminating intercompany was dividend. And we must first of all analyze it to see what is our intercompany dividend. And from there, we'll proceed towards elimination. Okay, any question? Any question here? Now, if you go back to our material, you see that in similar manner, in the textbook, we did the same thing. But again, all what I've explained in words are documented in the solution here. Okay, and you can see the way we cancel out here, 2,000 plus 0 minus 2,000 intercompany. Okay, and how we eliminate all are there. And the explanation for why we do that are also here. For example, the amount of dividend income to be eliminated is a portion traceable to have been earned and received from other entities within the group during the reporting period. In this context, the amount of dividend paid by subsidiary was 2.5 million, of which 80% is received by the parent in the sum of 2 million naira. Hence, the amount reported in the parent's profit or loss also amounted to 2 million, which implies that the amount represents the dividend income solely received by the parent from the subsidiary in the reporting period. Likewise, the sum of 500,000 being the portion of 20% of 2.5 million of the subsidiary dividend paid to non-controlling interest have to be deducted from the amount of non-controlling interest so as to reduce from the amount of subsidiary's profit already attributed to non-controlling interest because dividend is paid out of profit. Also, Chelsea profit after tax is shared between the parent and non-controlling interest in the ratio 80-20, in which profit or loss is required to be allocated based on the stake held in the ordinary shares of the subsidiary. And remember, how do we determine this 38 again? We consider the post-acquisition, which is the difference between the retained earnings brought forward for the subsidiary and the pre-acquisition. That gives us that 47,500, which will now apply 80% similarly here also. And that's how you produce that result. Now let's look at this in addition to what we'll more or less consider. And in this case, we'll be looking at another adjustment and see what happened in this situation. Okay. Now, this situation is also dividend, but what you observe, okay, I won't tell you what you observe. I'll see whether you are able to observe it. Okay, can somebody read illustration 5? Who volunteers? Mr. Demi, can you read illustration 5?
Arsenal acquired 80% interest in the equity of Chelsea as at January 1, 2014, when the retained earnings stood at 20 million naira. The board of Arsenal strictly wants to comply with the requirement of IFRS regarding consolidation of the financial statements of the subsidiary with that of the parent as at December 31, 2016. Income statement for the year ended December 31, 2016 is as follows. Revenue, Arsenal, all figures in thousands. Revenue, 600,000 for Arsenal, 380,000 for Chelsea. Cost of sales, 345,000 for Arsenal, 201,000 for Chelsea. Gross profit, 255,000 for Arsenal, 189,000 for Chelsea. Distribution cost, 75,000 for Arsenal, 45,000 for Chelsea. Administrative expenses, 108,000 for Arsenal, 90,000 for Chelsea. Dividend income, 3,000 for Arsenal, nil for Chelsea. Profit before tax, 75,000 for Arsenal, 54,000 for Chelsea. Next slide, please. Income tax, 25,000 for Asna, 29,000 for Chelsea. Profit for the year, 50,000 for Asna, 25,000 for Chelsea. Movement in reserves, retained profit brought forward, 120,000 for Asna, 67,500 for Chelsea. Profit for the year, 50,000 for Asna, 25,000 for Chelsea. Dividend paid interim, 100,000 for Asna, 2,500 for Chelsea. Retained profit carried forward, 160,000 for Asna, 90,000 for Chelsea. You are required to prepare the consolidated profit or loss and the consolidated statement of changes in equity, given that the share capital of Arsenal stood at 200 million naira and that of Chelsea amounted to 100 million naira, and the amount of non-controlling interest at acquisition as measured at fair value stood at 24 million naira. In this context of the text, we will approach a step by step. Okay, sir.
Is that the context now?
Yes, sir.
Thanks. Okay, now we'll look at what we need to do in this case. Now it's the same question. Who can tell me what is different in that question? Let me show you at a glance here. Look at those things I highlighted. Okay, what can you deduce between this point and this point? Who will provide guidance?
Sir.
Yes, we can hear you.
Okay, sir. The parent got dividend income of 3 million, which is higher than what the subsidiary paid. It means that the parent got dividend from another means aside the one gotten from the subsidiary. If I'm right. No.
Okay, who else? Okay. Let me do something now. Now, this is what we did the other time. Analysis. Now, let me link it. Remember, it is 80-20. Now, what was the dividend declared? Is C25, have you? Therefore, I put the 25 here. Now, 80% of 25, how much is it? That's 2. And 20% of 25. That's 500. Now, which means these 25, as said earlier, can be split into parents, and NCI. Okay, parent is 2,000, NCI is 500 from this information, and parent is cancelled out. This is cancelled out. Okay, now, but let's check here. What was recognized by the parent as dividend income? 3 million. But what is due or received from the subsidiary is 2 million. Who can account for the difference between 3 million and 2 million? Who will account for the difference? What will bring about that difference? Is it that there's an error? Okay, somebody sent a chat saying the parent company received dividend from subsidiary and other investment, which means there is a possibility that there are other investments within the group in which the parent has received 1 million naira. Yes, that is 100% correct. And that's why you must carry out this analysis to ensure that you are not just saying any dividend income, you eliminate. No, you only eliminate any dividend income attributed to what was received from another member within the group, not what was received from independent third parties. Therefore, it means I'm only going to eliminate 2. From this question here, I go back here. I need to populate my revenue. Okay, my costs and all of those. Okay, to do that, according to what is in the information here. Sorry. Okay. Now, if that is the case, what am I eliminating is 2. I'm not eliminating 3 million, which means by doing so, I will eliminate this 2, which is also this 2 that you have here. Okay. I can link it. Okay, these are 0, 0, 0, 0. Okay, 0. Now I've linked it. Therefore, you find out that you now have a balance of 1 million, which is genuine. It is genuine because it is actually the income to the group because it's what was flowing from other investments outside the group. Now everything sums up to 73. Okay. But 50 and 25 is 75. Is this adjustment? Some of the adjustment that make it 73. Therefore, as usual, 50 belongs solely to the parent. Out of this 25, 80% of it belongs to the parent, and 20% of the 25, which is 5, belongs to the subsidiary. Now, this adjustment is only to the parent, as you can see it here. Okay, it's a deduction, and that's how we arrive at 68 and 5. okay, which when you come here, we've added here. Now, I've emphasized it here. This 1 million will not be cancelled out because it constitutes other dividend income outside the group. Okay, yeah. Our figure in thousands. What's our pre-acquisition reserve? Is 20 million. What's our subsidiaries retained profit? 67,500. What's our parents' retained profit brought forward? 120. What's our non-controlling interest measured at acquisition date fair value? 24. Now we want to find the difference between these two in order to determine the post-acquisition retained earnings brought forward for the subsidiary. Therefore, we've already done similar thing here. I just copy the formula there and I paste it, and it's able to give me the difference, which is 67,500 minus 20. Okay, in which this 120 is coming from here because it's a parent retained earnings brought forward, and 38, even though I independently calculate it here, I can as well just say 80% of the 47,500. Here, the 24 million is coming from the information provided. And this 95, independently, I can say it is 20% of 47,500. And that gives me this position that flows in here and here. But also we have the information that Arsenal has a share capital of 200 million. And this retained the profit already, 68 and 5 is already reflected here. Now the next thing is dividend. We need to remove the 500, if you remember, which is already paid out of the 5,000 profit attributed to NCI. Okay? And also the parent on a standalone basis equally paid dividend of 10,000, which reduces his retained profit by that same amount. And therefore, I can sum everything up again and cast it to see that all is equal. And that's that, which means the only thing I've introduced here is the fact that not all times will you eliminate all the dividend income. You only eliminate it to the extent that is intercompany. And that is as determined at this session here. You must always carry out dividend analysis to know what portion of it relates to intercompany and require elimination. Okay, that is that. Any question on that? Any question on that? For you guys not to ask questions, there are two possible assumptions. 100% you are getting it, or you require to just remain silent, probably because you are not getting it. Which of the two is a position? Which of the two?
Question from me, sir.
Any other person?
I'm getting it so far. I might need to read up on it later. Thank you, sir.
Okay. Who else? Okay. Okay, now we'll be looking at additional illustration to demonstrate how we eliminate some other transactions, especially as it relates to financial arrangements within the group. Financing arrangement within the group entails where within the group, most especially within the parent entity, which also serves as a management entity, where corporate treasury is carried out with respect to maximizing the cash pooling system within the group, where the deficit units and the surplus units are managed centrally. A surplus unit is a member of the group, be it a parent or subsidiary or whoever it is within the group that has free cash flow. And instead of placing such money in the bank at probably 10%, you place it within the centralized treasury unit at, let me say, 12 or 15%. And instead of the other entity within the group, also that is a deficit unit who is in need of funds for at least working capital or otherwise, instead of them approaching the bank and obtain facility at 20% or 22 or 24%, you can equally get it at 18%. Now, what that means is that, let's say the parent, for short, has surplus cash. Instead of the parent placing it at a bank for 10 to 12%, the parent can now lend it to the subsidiary at 18%, whereas the subsidiary, instead of approaching the bank to get a loan at 24%, you get it at 18%, which then means that technically, due to this arrangement within the group, they are able to more or less maximize return by saving the cost that will have gone to bank in terms of bank intermediation. Okay, because if they have approached bank separately, one fixed the money at 10%, one borrowed at 22%, therefore the bank is taking a margin or a spread of 12%. And therefore that 12%, rather than go to the bank, is being spread within the members of the group. And those are the synergies that you create within a group by way of financing arrangement. But what is the implication of this financing arrangement? Is that within the group, the interest income constitute an intercompany income from a transaction. And interest expense also constitutes an intercompany interest expense, which means on one hand, you are making income, on the other hand, you are making expense from yourself. Remember, the parent and subsidiary are considered to be of a single entity. Therefore, in that regard, such transaction should not have created income from the group perspective. Though in the individual perspectives, it constitutes income and expense, respectively. But from the group perspective, there is no income or expense attributed to such an intercompany financing arrangement. Therefore, what do we do at that point in time is for us to identify the amount of interest that constitutes intercompany income and expense, and then eliminate such item. And eliminating such item means that in the books of the lender who has recognized an income, from the group perspective, we eliminate it. And in the books of the borrower who has recognized an expense, from the group perspective, what then do we do? We also eliminate it. At the end of the day, the net effect on profit is zero, all because one side is showing an income, the other side is showing an expense, and upon netting it off, still doesn't change our profit position, but rather it allows us to reflect the true line-by-line item that depict the performance of the company, of the group as a whole, as an economic unit, rather than just a mere addition or consolidation. And therefore, I want somebody to read up this for us, and from there, we'll look at practical demonstration of the application of the understanding of the principle regarding elimination of intercompany interest income and interest expense arising from intra-group financing arrangements. Who will volunteer? Over to you guys.
Intergroup interest. Where a parent company to the subsidiary or vice versa, or in an extreme situation, the resulting interest represents an expense in the subsidiary financial statement. as may be shown under the heading finance cost or interest expense. Parents that include the same amount interest income or finance income. Upon consolidation, these amounts, interest expense and interest income, by making as an adjustment to the expense and income in the consolidated. The elimination of intercompany interest income activities necessitated this signifies that non-elimination of interest expense and interest income that amount to a regain submission that tend to reflect and charge for true and financial. My network is full.
Yeah, your network is cracking. Okay, can somebody else take it off from the beginning? Your network is cracking and very low. Okay, Janet, can you consider it? Can you take it up, please?
Consolidation subsequent to acquisition in group account and elimination of intercompany interest, income, and expense. Intragroup interest, where a parent company makes a loan to a subsidiary or vice versa, but in an extreme situation, the resulting interest represents an expense in the subsidiary's financial statement, as may be shown under the heading of finance costs or interest expense. The parents will have included the same amount being interest in the financial statement line of investment income or finance income or other income. Upon consolidation, this amount, interest expense and interest income, must be eliminated by making an appropriate entry as an adjustment to the expense and income lines within the consolidated statement of profit or loss. The elimination of intercompany interest income and expense is necessitated on the premise of the principle of single entity concept, which signifies that the non-elimination of the intercompany interest expense and interest income will be tantamount to a mere summation of amount attributable to items within the financial statement that tends to reflect the financial performance, but not really the true and economic position of the group financial performance. In a simple sense, a group cannot be seen to have made income out of itself and simultaneously such income taken out via recognition of expense for the same amount. Hence, the only amount of interest income and interest expense to be recognized in the group account are those attributable to what was earned and incurred during the reporting period. Like continue, sir.
Yes, therefore, this depicts what I've explained from a single entity concept. Therefore, on that basis, can you read the illustration 6?
Illustration 6. Arsenal acquired 80% interest in the equity of Chelsea as January 1st, 2014, when the retained earnings stood at 20 million naira. The board of Arsenal strictly wants to comply with the requirements of IFRS regarding consolidation of the financial statement of the subsidiary with that of the parent as at December 31, 2016. Income statement for the year ended December 31, 2016. Arsenal Chelsea in million naira. Revenue 600,000 for Arsenal. For Chelsea 390,000. Cost of sales for Arsenal is 345,000 naira. For Chelsea 201,000 naira. Gross profit 255,000 for Arsenal, 189,000 for Chelsea. Distribution cost 75,000 naira for Arsenal, 45,000 naira for Chelsea. Administrative expenses, 95,000 for Arsenal, 80,000 for Chelsea. Investment income, 10,000 for Arsenal, nil for Chelsea. Operating profit, 95,000 for Arsenal, 64,000 for Chelsea. Finance cost, 20,000 naira for Arsenal, 10,000 naira for Chelsea. Profit on before tax, 75,000 naira for Arsenal, 54,000 naira for Chelsea. Income tax, 25,000 Arsenal, 29,000 Chelsea. Profit for the year, 50,000 Arsenal, 25,000. Movement in reserves. Retained profit brought forward, 120,000 for Arsenal, 65,000 for Chelsea. Profit for the year, 50,000 for Arsenal, 25,000 for Chelsea. Retained profit carried forward, 170,000 naira for Arsenal, 90,000 naira for Chelsea. Required. Prepare the consolidated of profit or loss and the consolidated statement of profit or loss and the consolidated statement of changes in equity, given that the share capital of Arsenal stood at 200 million naira and that of Chelsea amounted to 100 million naira, and the amount of non-controlling interest at acquisition as measured at fair value stood at 24 million naira. As at 1st January 2016, the parent provided a loan facility of 100 million naira to the subsidiary at an interest rate of 10% per annum. The loan remains outstanding as at the reporting date. The interest income is reported as an investment income in the books of the parent as shown in the financial statement for the year ended 31st December 2016. In this context.
Okay, thank you very much.
Okay.
Now, this has been more or less translated to what we have here in our spreadsheet. Now, what then do we need to do? Okay, now first, let's copy what we have directly from the question. Therefore, this is what we have exactly from the question, okay? Therefore, what do I need to do is to more or less analyze one or two things. Now, when you see here, they said as at 1st of January 2016, which is, I think, beginning of that year, the parent provided a loan facility of 100 million naira to the subsidiary at an interest of 10% per annum. And we are told that the loan is still outstanding as at the reporting date. When we look at that, let's just do some analysis. If the loan okay, let me just do an analysis here. Now, what will have been the interest on the loan for the full year? It will have been 10% multiplied by 12 months, full year over 12 months, multiplied by the 100 million. Why am I doing what I'm doing? I'm doing this because what if the loan was given on 1st of July 2016 in that year? It then means you only compute for 6 months. But in this case, the loan is standing for exactly 1 year, which means 12 over 12 will give you 1. And it doesn't change what we have. But if it's 6 months, 7 months, 8 months, 3 months, it will not be those months over 12. And in that situation, what do you have? You have to prorate. Therefore, in this case, we are carrying out this analysis to establish something. And what is that? First, let's check. When we do this, what is the result we have? The result we have will be 10% times 12 divided by 12 multiplied by 100 million. That will give me what? That will give me 10 million naira. Okay. Okay, let me find where I have a standalone naira. Okay, yeah. Okay. Now that is that. Now this 10 million naira, let's confirm how it has been accounted for in the individual financial statements. Investment income, which means interest income there, the parent has recognized that 10 million, which corresponds to this 10 million we derived here. And the subsidiary has recognized interest expense by way of finance cost of 10 million. Which that means that what do? This 10 million and this 10 million are intercompany. On one side is an income, on the other side is an expense. What then do? We cancel it out. To cancel out an income, income has a credit balance. What do? You debit an income. To cancel an expense, expense has a debit balance. What do? You credit an expense. And that is what triggered that in the books of the parent where we have investment income, we debit it, and in the books of subsidiary where you have finance costs, we credit it. With how much? With this 10 million. And therefore, I'll put this thing in thousands. That's it. Therefore, in this case, what do? I come back here and see how I eliminated. Investment income, I deduct 10 million, so that by the time I net it off, it becomes 0. For finance costs, remember parent has his own 20 million separately, that's not affected. But you could see the gray line and the shaded gray. We have expense, finance costs of the subsidiary. Upon elimination, we credit it. Therefore, this 10 nullifies this 10, and this 20 is standing here. Which means invariably, it still doesn't change the profitability, but we have not knocked out the investment income and the finance cost. And that's why when you see the financial statement, you see that there's no investment income, neither is there a finance cost attributed to intercompany transaction. The only finance cost you saw here is actually the finance cost of the parent to third parties or to third-party financial institutions. Therefore, how do we allocate or how do we attribute this 75? It's broken down into 50 and 25 and is zero adjustment. Why? Because this perfectly knocked out one another. Therefore, we take 80, this entire 50 million goes to the parents, while 80% of 25 goes to the parents from the subsidiary, and 20% goes to the NCI. Now, eliminating investment income. On one side, we eliminated investment income, which is what you found there. On the other side, we eliminated by increasing by way of credit charge or credit entry to the finance cost an increase of 10, which means net, this 10 cancel this 10, and that's what we're trying to achieve. And this produces 70 and 50. And in that light, we have this position here, which is reflected here. Okay, now that is that. Now to reflect it within our statement of changes in equity, we come back here, we already have 75. What is the share capital? The share capital is 200 million. Now let's come back here. What is pre-acquisition reserve? Pre-acquisition reserve is 20 million. What is subsidiaries profits? Reserve as at acquisition, 65. 65 comes here as my input. In that case, I've been able to determine post-acquisition reserve brought forward for the subsidiary. The parent retained earnings brought forward is 120. Non-controlling interest as measured as fair value at acquisition date was 24. Therefore, I can start here. Parent retained earnings brought forward, I have it as 120. Now, 80% share to the parent, the post-acquisition retained earnings brought forward of the subsidiary. Remember, our 80% of the 45 million post-acquisition reserve brought forward. That gives me 36. It seems the network went off. Can you remember where we stopped? Can we remember where we stopped before the network went off?
We actually have the statement of change in equity and the share capital.
Okay, let me go back here. Now the share capital, remember, we're able to determine it at 200. Now we come back here, we populated all of this, and we said to determine the consolidated retained earnings brought forward, what we need to do is to carry out necessary imputation. First one is that the parent retained earnings brought forward is 120, which came from here, and NCI is 24, which came from here. Now, 80% share to the parent, the post-acquisition retained earnings brought forward of the subsidiary is 80%. Remember, we have our percentage locked down here, multiplied by our post-acquisition reserve of the subsidiary brought forward, 45. That gives us 36. And this 156, which is the sum of 120 and 36, flowed into the statement of consolidated statement of changes in equity. Now, similarly, the balance of the 20% of this 45 will be reported within non-controlling interest. And 24 and 9 give us 33, which flows on here. Okay, now all things being equal, we have this position. Okay, and at the end of the day, we are able to produce these results that we are seeing here. which means here there's no more investment income. Technically, this investment income was canceled out in total or in full. Okay. I think I have somewhere where I can copy this to show how it came to 0. Okay, something like this. I can copy it here. Okay, that is that. And if you check how did it cancel out, you can see where it breaks out here. Okay, probably let me put it in gray. Okay, and that is that. Any question on this? Remember, you need to carry out this analysis so that not every time just carry the entire interest cost and interest income and you eliminate, because some of it might be attributed to external financing. Okay, take note. Any question? Okay. Okay. Now, against the next class, we will try and look at critical adjustments such as intercompany sale of goods, where we'll be eliminating the intercompany sales and cost of sales, and where we also extend the elimination to adjusting for unrealized profit and the effect of that unrealized profit in profit attribution to the parent and the non-controlling interest. We also look at the aspect of where you transfer plants or you sell assets within the group, and there's profit on disposal. I will eliminate that profit upon disposal. And subsequently, the effect of that on depreciation going forward, I will make adjustment for excess depreciation and the profit or loss, and how all of this affects the consolidated statement of changes in equity. All of these are what we are going to consider in the next class. Okay? Now, the floor is open to ask other pertinent questions, if any. Any other question? Any other question? Okay, if there's none, I'll provide you these templates. And I will advise you to play with the following questions based on the understanding of what we have when we're doing the consolidated statement of financial position, which is the balance sheet, with respect to adjustments for unrealized profits or sale of goods and sale of assets, and adjustment for excess depreciation on sale of assets, the subsequent effects, and also elimination of intercompany transaction, such as intercompany sale of goods, which is the revenue, and intercompany cost of sales. And that means if you check what I'm going to share with you now, I want you guys to play with this question, and the questions are already there. Okay, it's just for us to solve it. Let me show you. The template are also there. Question illustration 7, which introduces issue that borders on intercompany sale of goods, And also the perspective also borders on, is it the parent that is making the sales or the subsidiary? We take us to the issue of downstream transaction and upstream transaction. Okay. Any other question? Any other question? Okay. If none, thank you very much and God bless you.
Thank you, sir.
Thank you, sir. Thank you, sir.